Welcome everyone to today's webinar, co-hosted by Orrick and Oxx. Our theme for today is term sheets in the age of COVID-19, which we thought would be a timely topic considering the changing circumstances we've all been through over the last 3 to 4 months. Hopefully we'll be able to touch upon some key questions that are top of mind for entrepreneurs and teams currently considering their fundraising strategies. We'll go on with a fireside style chat for about 30 minutes with room for some Q&A towards the end. Now, most of you tuning in are probably familiar with our respective organizations, but for those that are not, Oxx is a venture firm investing exclusively in B2B SaaS companies across Europe and Israel. We do that from offices in London and Stockholm, and beyond our specific focus on B2B SaaS, we also specialize in investing in companies that have reached what we refer to as the scale-up stage, meaning companies that can show clear product market fit and with emerging signs of business model market fit. That means we typically invest in late A rounds, early B rounds, and actually also in between in what we call the Series A and a halves. In terms of check size, we're typically writing $5 to $7 million initial checks with $10 million plus invested over the life of an investment. As regards myself, I'm a general partner at Oxx and one of the 2 co-founders of the firm. My personal background is 20 years as a venture investor in the Nordics, with more than 30 completed transactions, including minority and majority investments, as well as M&A and IPOs. On the webinar today, I'm very happy to have with me Ylan Steiner, who is a partner with Orrick and widely recognized as one of the most prominent lawyers in European venture and growth stage tech. I will now hand over to Ylan to let him introduce himself and perhaps say a few words about Orrick as well.
Hi, hello all. Ylan Steiner here, partner at Orrick. Orrick is a Californian headquartered and Californian mindset, and our heart headquarters are all based in California and Silicon Valley, but with a very strong European presence, both in London and across the continent in France, Germany, and Spain particularly. One of the real focuses that our firm has is working with technology companies on a stage agnostic approach to the tech industry. That means we love meeting really exciting, promising and ambitious, very early stage companies, even at incorporation stage and seed or pre-seed stage. And we like meeting those companies because we like going on the journey with companies like that as they work their way through the alphabet into larger and larger series of financings and ultimately towards an exit IPO or some kind of other strategy, staying as an independent entity and making acquisitions on their own. So in terms of volume and type of transactions that we're working with, to give you a feel, last year our London team completed 225 financings of tech-related companies. Of those, a majority of those were company side mandates. We do clearly work with some very good investors in the community also, but company side mandates as a predominant focus. And whilst many of those companies were very early stage, as we said, a lot of those were companies going through into significant financing rounds of tens of millions, hundreds of millions of dollars. Even at unicorn status. So, some of the poster children of the companies that we've worked with throughout the years are companies in the US like Revolut, like Beyond Meat, like Stripe, now is a $34 billion company, or 35 at its last valuation. And in the UK, Graphcore, Revolut, and others that we've worked with from very early stage. What makes us excited is, yes, we have some great big companies we work with like Microsoft and Sybase and Oracle that we're very regularly working with as clients of our tech practice. But we have 28 or 2,900 companies on an international basis that we're working with. And it's those that are breaking through from the earlier and growth into scale up and large unicorns in their own rights that are the ones that excite us and keep us going and coming into the office every day.
Thank you, Ylan. We'll get going here with the discussion, but just before we do, I want to remind everyone that if you have a question that you would like us to bring up and discuss, you can post it as it appears by hitting the Q&A button in Zoom, and we'll try to pick that up towards the end. Now, Ylan, obviously, as the pandemic hit and things started to shut down, there was a big question if deals were going to get done at all or come to a complete halt. And for a couple of weeks, at least, to a month maybe, I think we saw a big hesitation from investors taking on any new deals. But it looks as if that has changed and deals are not getting done, despite an inability to meet people face to face. Would you agree that that is the case you see? And if so, are there any characteristic traits for the type of deals that are getting done?
Okay, so there's a few parts to that. I guess the first part is when the pandemic first hit, and we're talking about mid to late March, I think there was a large degree of uncertainty. And anyone who had a term sheet that was out there and was mid-transaction likely accelerated that transaction. We didn't see few on the financing side where those transactions went into a holding pattern, as we did with some of the M&A. People generally looked to honor the term sheets that were there. And we probably also saw a quick acceleration of some term sheets where people looked ahead, thought that there was a level of uncertainty coming forward, and thought it useful to tap the markets quickly for traditionally a bridge financing to extend their runway. Then it went very quiet. And by very quiet, I mean very quiet in that I think everyone looked at their own house. Everyone looked at both their own businesses and what they were doing within them, trying to understand then what their customers were doing. In the case of investors, looking at some of their portfolio companies particularly, as well as themselves as a business, and how each of us might look at the future. And I think very quickly that turned into a general belief that tech would be one of the industries that would be least affected, and I'm going to turn that into a much bigger positive, that would actually be a net beneficiary out of some of the turmoil and uncertainty of a pretty unparalleled everyone staying at home and not leaving their homes for the period that we've done so.
Yeah, no, it's certainly, and I think we've seen as well, like you said, it became quiet, but then people realized that there actually are specific companies or niches or sectors, if you like, that will actually benefit from the current working from home trend and remote work overall. So it seems like there's a lot of companies that people are actually rather trying to get involved with, even more so than pre to COVID there. But yeah. I mean, if
the cliches on that, Mikael, are obvious. Anyone who is involved in any kind of hospitality or travel would have seen business falling off a cliff. Quite literally, it would have been a very difficult moment for those. For anyone who had, from a retail perspective, an online presence, they would have seen a boost to their online revenues. And for an online only businesses, actually, there was a lot of positives that come out of that. Conversely, anyone that had anything to do with remote working, and some of the stats on participants like Zoom and others, and we recently closed last week the financing of a company called Hopin, which is very exciting in that it's providing online events. They are areas that have particularly benefited from the uncertainty and the remote working that we've all been doing. But I think, as I said, tech generally is the beneficiary of this, and one of my favorite memes of the pandemic has been the one that asked the question about who led the digital transformation of your company, and the multiple choice answers were A, the CEO, B, the CTO, and C, COVID-19. And COVID-19 is circled because that's where much of the growth is coming from at the moment.
Yeah. I mean, the deals are definitely getting done, and there are certain companies that are far, much better than other ones. But we have certainly seen situations, I guess, in our portfolio and elsewhere, where outside investors felt that this was the time to make hay, and they're going to take, massive advantage of the situation where most investors would be tending to their own portfolios, and having fresh capital was a competitive advantage. So they came out in the market going after companies with some, what I would call, fairly aggressive term. Have you seen a lot of that? And what, if so, what are the major terms that are changing? Be it valuations? Is it, different round sizes, people lowering in round sizes? Is it different types of instruments, or what is it?
So the first and obvious move that we anticipated and saw happening was a move to the convertible loan note rather than a price grant. And all that did was allow a company to be funded quite simply, quite easily, but without having to make the valuation decisions around pricing at that point. And very interestingly, and quite soon after we went into lockdown, this was 20th of April, the government announced the Future Fund, which allowed or supported, as a bit of government intervention, supported the venture capital community and other early stage and growth stage businesses in providing, by way of convertible loan notes, some additional support. And I think the numbers of that probably has skewed our market slightly for the time that was out there. The last stats that the government have announced were that 320 companies have been financed through the scheme. And we know of many tens or hundreds more that will be financed or that have applications in for financing. So, there's a large number of financings happening by way of convertible notes. Within the traditional financings, we have seen the return of some of the kind of, you can call them Frankenstein terms that come through on any downturn. And there will be some rogue operators there who might try to take advantage of the situation that was there. So, liquidation preferences going up instead of a 1x non-participating liquidation preference, moving to something more extreme, 2x or 3x, and we saw one 4x that was put in place. There are different reasons why some of these are there. I mean, in part it's to wash out existing investors who don't participate and follow on, and in part it's to recompense the investors who are taking the lead in financing and supporting the company, and leaving behind the freeloaders or recompensing them for doing that. We see a few examples of that having happened. There is always a rationale for it in the circumstances, and not too aggressive. I mean, I go back to 1999, and I'm aging myself in this, where I had one company with a 10x participating preference ahead of everyone, but that was very clearly designed to penalize and wash out anyone else who wasn't participating.
Wow, 10x. I think I would blush if I was the investor proposing that to an entrepreneur. So, other than, obviously the participating pref is something we've seen around, and, the multiples on the minimum return coming up as well. Are there any others, like aggressive terms like, full ratchets, redemption rights, stuff like that you've seen?
So full ratchet people talk about, although we've not seen in any of the term sheets over the last while any or many full ratchets coming back in. I think as a concept it was quite widely adopted when the concept, again putting a historical perspective on it, in the late 1990s when it first came through. But I think the acceptance of a weighted average, slightly less blunt instrument of the weighted average, and looking at the seismic impact of the dilution rather than just the price at which it was done, is something that the industry has broadly accepted. So we've not seen many of those. Redemption rights are something which we see more of in the US than we have done in the UK, and I think anecdotally across the continent also. Part of the reason for that is probably cultural, but also I think part of the reason is because in the US a buyback or redemption is much easier to do from a company law perspective than it is in the UK or on the continent. And so we see less of that. We do see a little bit of investors wanting to take a little bit more control around the timing for an exit and the process for an exit. And so we're seeing documentation recognizing that there is a period of uncertainty where no one wants to necessarily force a sale, but looking to strengthen their hand in implementing the sale in the year or 2 or 3 years time when the market returns. And so looking at terms now that might strengthen their hand to make sure that a sale can happen when they're ready to do so.
So if you're an entrepreneur raising money right now, things to keep track of, obviously, the types of preference shares and the details around that. ratchets, redemption rights, and the exit mechanism. Is there anything else? What are the anything else? One or two things to really keep top of mind as you're negotiating a term sheet in this market right now?
Valuation is interesting because there are lots of ways of coming out with the value of a startup that don't necessarily look to the fundamentals of the business. And we had a number of company side mandates where the investors have price chipped an existing term sheet or have come in at a valuation lower than what was originally suggested. In a couple of cases, that's been swallowed and accepted and closed. In one or two cases, what we were able to do is look at what was proposed in the business plan for what the valuation was, and suggesting in some kind of reverse earnout, if I can call it that if the company were to hit the projections in its business plan in a year's time, in 2 years' time, that although the valuation would be accepted now at the lower valuation, it should be adjusted in a year or 2 years' time if the company was able to perform. So that's a confident management team looking at the uncertainty and saying it doesn't impact our business plan, therefore our valuation should be unaffected.
Yeah. So I mean, all those sort of like performance mechanism, and clearly you spoke earlier about the convertible note, which is really a way to kick the can down the road, right? It's a way for people to meet in terms of market uncertainty. Do you see a challenge with so many convertible note fundings getting done? There could obviously be a hangover down the road if things don't pan out as people hope.
Sure, I think that's a realistic expectation. Traditionally, a convertible loan note had a 6 to 12 month lifespan on it. It was really a bridge to the next round, and it wasn't anticipated that it would be out there for so long. One of the interesting parts of the Future Fund is that in setting the time for its convertible notes and the conversion mechanics, was they've put a 3-year time period, which cannot be brought forward. So it's a fixed 3-year period under the Future Fund. And the idea for that was a hope and expectation that there wouldn't be a default trigger of the conversion mechanism, that the company would be allowed sufficient time for the C19 uncertainty and turmoil to have worked its way through, that it can get an independent pricing event, be it a further financing or an exit, before that conversion needs to happen. And as a result, a 3-year period should be a long time for that. I'm going to say that there are more convertible notes that we have a firm are putting in place now that are C19 and a Future Fund compliant and have a 3-year period, then have a shorter period. And so it's possible that overhang is still 3 years away, which is a long time in the life of a growth company.
Yeah, interesting. Okay, so moving perhaps slightly beyond just the term sheet here. I mean, in terms of deal lead times, do you see deals taking longer for people to complete? And if so, do you think that's because of difficulties that people can't meet in person and can't therefore complete the due diligence the way they want? Or is it because investors are simply taking liberties, buying time to see monthly results and metrics come through?
I'm going to, an interesting part of that is at the start of the uncertainty, and we spoke to a bunch of the investor clients who we work with and companies, and most of the investors that you spoke to, they're all open for business. Of course, they're all funding new and exciting companies. But when you spoke to them one-on-one, very often the answer came back, of course we're looking at business plans, of course we're meeting companies and we're building that pipeline and that funnel. But we can't imagine a world where, as our thesis and how we operate, that we could see ourselves investing in a company where we haven't met the management team, where we haven't sat down and sat with them around a desk, around a restaurant table with a drink, whatever that is, just got to know them as people in working that through. And fast forward 3 months, we see tons of people doing deals, submitting term sheets, and executing on those without having met their management team. So we're adaptable as humans is the answer. We've learned a lot, and people have adapted in 3 months. I'm going to say, converse to your question, actually we see deal times shortened. And we're seeing lots of people very keen on get things done in a week, get things done in 2 weeks. And I think one of the reasons for that is there is a sense of urgency. There is a belief that our recovery has been very much of a V, but that we might have that stroke down and start maybe of a W or something like that. And so, the general trend or belief is that tech will be a winner. We need to do that. We need to do that now. There is some pent-up demand. I think people also have fewer distractions whilst we're all locked up at home, if I can call it that. And so, there is very focused work on, if there is a project, it's very much more focused. We don't have the same level of distractions, any of us, that we had before. So things are getting done quicker.
That's really interesting. And with that, do you see a change in dropout rates in terms of transactions being aborted and not getting done if people are trying to speed things up, or does that simply mean that people can't take the time to do the work they would normally do to find everything that's sort of hidden beneath the surface, so they go ahead and complete the transactions instead?
As lawyers, we probably join a transaction slightly later in its life cycle than you would, because you're starting all of those earlier investments. There are a number of companies where I, sit as observer on the board and see. I've seen the life cycle of some of the deals. We're not seeing particular dropouts on any transactions. We're not seeing term sheets that are issued which are subsequently not completed. We're seeing competitive term sheets and fiercely competitive term sheets, and have been running two alongside each other on something recently also. But that's just the opportunity of the market at the moment.
Interesting. Okay. I mean, you alluded to it a little bit here, that, how, we're thinking about a V-shaped recovery here, and, there might be a second wave here, and there could be some really draconian long-term effects on the real economy here. So, if it was initially difficult getting deals done and people were hesitant, and then we're sort of beyond that now, do you see an argument for people who are considering their fundraising strategies to actually push the button and go right now before there is a second wave, or before the longer term effects and impact on the economy can be felt really badly?
I'm not sure a massive scramble to the market is a positive for the market, but yes, I do think the environment right now, that people would have expressed concern about the market, about willingness of participants to invest, about whether the wheels were turning, and that all does seem to be happening. I guess from a UK perspective, there's a lot of people who have booked a hairdresser on the 4th of July. There's a lot of pent-up demand. Not something I necessarily have an issue with, but a lot of people will be making early appointments because there is that kind of pent-up demand, and it will take a little while to work through the system, but then it will normalize. I think we have a degree of uncertainty in our market going forward, but as I mentioned earlier on, I think the great recognition is that tech will be the winner through that. Not every tech company, of course, but tech as an industry, and where we're working, and some of the things that some of the clients that we're working with are doing, it's a very exciting market and time for them to be operating.
Yeah. So speaking of pent-up demand, I know you're obviously involved a lot in M&A as well. We obviously have a major interest in the state of the M&A market as well, with the types of companies you invest in, and have lots of interest from people around M&A there. So, we've obviously been focusing on financing in terms of there, but what is the current status that you see within the M&A market? Is there activity there, or is it a more prolonged pause, and is there pent-up demand, or what are your thoughts on that?
So I think the pause on M&A has been more prolonged. I think that's a perfect explanation for it. That's not to say that M&A isn't happening. And one of my colleagues recently closed a sale of a company to Siemens. And so, that's big corporates making acquisitions within the tech market. It is happening, and there are others that we are working on. We're not yet seeing, and I think that's sort of what we anticipate might fuel some of the M&A market for a short while, distressed M&A, companies that haven't managed to get financing, or companies that are where the investors are looking for that shorter exit. And we've not yet seen a stream of distressed financings, or sorry, distressed M&A happening yet. We anticipate that will happen. That will probably come in the flavor of, single assets being sold, potentially two competing technologies, both VC backed, deciding to join, maybe the number 3 and the number 5 in the market combining to have a kind of combined attack at becoming a market participant or leader in their market. We think we'll see a few of those, but those haven't yet come to the market. They shouldn't be far away though.
Okay, it's very interesting. I'm actually going to move on now to Q&A. We've had a number of questions coming through here, so I'll start going on those as they come in here. So the first one says, we understand that investors need to spend the money they have raised with their investors, so lowering valuations and making term sheets less favorable for startups sounds also like taking advantage of the COVID situation. What do you think? So, I mean, I'll let you talk to that, and I'll give you my perspective.
Well, I'm going to say it's a competitive market, and we see in so many cases when people are submitting a term sheet that they're doing so in competition with other investors. And so, there isn't the ability to carve out the market and agree that we're all submitting, or that you are all submitting lower term sheets. I guess the other part is, although you are very much incentivized and keen to spend the funds and to invest the funds that you have raised, at the same time, your investors wouldn't thank you were you to invest those unwisely. And so, sitting back and not investing through an uncomfortable period or an uncertain period is also an approach that some firms or funds might be taking.
Yeah, if I may just follow on to that, I think the way we thought about it is just like you said, it's incredibly difficult to time the market, right? You can fine tune it at the edges, but trying to completely stop and then coming in and saying you're going to take advantage of a specific market situation, it's very difficult. It's a competitive market out there. There's lots and lots of money. And I think also from an investor perspective, you wouldn't want to have a reputation as a vulture investor, style investor, taking advantage of people in terms of uncertainty, right? So I think, no, I haven't seen, we've obviously saw initially some influx of people in the market who were trying to take advantage. Honestly, those were more US-based investors than Europeans. Nothing against US people over general or US firms, but they were much more aggressive in that. Whereas I think people who feel they're in their home market here were thinking a lot more about longer-term brand value and impact, and didn't want to, get that style of reputation for being super aggressive towards entrepreneurs. Good. So next question here. Startups which survived COVID and some even got stronger, or get stronger, I guess, should not be penalized with less favorable term sheets compared to the terms prior to COVID. On the contrary, those startups should be well supported. Don't you think? I think, that's pretty much what we have said here. I think the one thing to add to that is probably that we all understand we've been through a period of incredible and unprecedented economic growth. Valuations obviously reflect that, certain sectors even more so than other ones. And I think pretty much all investors are at least thinking about what are the long-term sustainable valuations out there. Because obviously we're dependent on selling companies 5 to 10 years down the road at some sort of multiple to, whether that's revenue, annual recurring revenue, or to EBITDA. So there is some thought going into it. But I think in general, the market dynamics and competitiveness is probably what's taking the charge and leading the valuations there. I don't know if you have another perspective, Ylan, or...
No, I think that's absolutely right. I mean, companies, when presenting themselves, need to show not just how they manage, how their business plans weather C19 and some of the uncertainty that remains around the timing of C19. And I think there is still a lot to play out in that regard. but also needs to understand what the position of the company is in a post-C19 environment, which I think everyone is quite keen to get to. It might take us a little bit longer to get there than we were all anticipating, but I think that's what the focus is. I'm going to say it's been really encouraging that there's been some activity within, I'm going to say, predominantly the US IPO markets, and we've seen Zoom Info and Vroom both listing. Vroom, who significantly increased its price range before IPO, and whose share price doubled on the first day of trading. Now, that's just a sign of we really don't know how the markets are going to take us, and the markets took it very well. And so, there's a whole load of other companies that are coming up towards potential IPOs, be it Robinhood or DoorDash or others in the US that are looking at this. It'll be interesting to see how quickly they approach the markets. We're coming into the summer months, which are never active months anyway from an IPO perspective. So that's a shame because we don't get the continual movement from it. But it's encouraging to see US IPO markets reopening.
Very good. So going on to slightly more detailed questions here. One for you, one for me. Ylan, what level of discounting, if any, have you seen in term sheet offers as a result of COVID-19? There's a lot of interest in valuations here. That's very obvious.
So on straight valuations, it's very difficult to know what discount to what it would have been previously. I think one of the things that we can look at very clearly, and when we look at discount, we look at discount rates on convertible loan notes. And I think going into the market, when you entered into a convertible note, traditionally that was priced at I'm going to say a 10 to a 20% discount to the future round. When the future fund priced itself and worked out how it operated, it fairly unashamedly started at a minimum discount of 20%. And it did that for a few reasons. And the first reason was, because it was a 3-year term, it could be out there for much longer, and that discount is spread over a longer period. It did also have an 8% interest rate, or minimum 8% interest rate, but it was a minimum 20. It was perceived that the market would move and that higher discounts would be required. But I guess the interesting part is, from the companies that we're working with and investors taking on the future fund, although there is a facility to increase the discount beyond 20%, not many people are doing that. So 20% seems to be the flat rate at which these are being done. And I'm sure there's a number of reasons for that. It's probably high enough. I don't think it's overstated. And the government very clearly, this is bailout money. And so they are unashamedly saying it's a little expensive, and if you can get funding cheaper privately, then do so. But this is not necessarily free money. I think the second part is, people would be concerned if they put too much of a discount into a current note as to what that might look like at the next financing round. No one wants to gouge a company too badly. And that comes back to the reputation, Mikael, that you were talking about, but also how that might look at the future future financing. What that does to dilution, of the investors in the earlier round, but actually more significantly the management team. And as a result of that dilution, if there is too much dilution, if this is retarded companies by a funding round, then there is just going to be a need to re-incentivize that management team with equity at a later stage, and that becomes a little bit more expensive. So I don't think people are being too opportunistic in their discounting, and recognizing that valuations need to ensure that there is still sufficient skin in the game and equity incentivization for the founder and management team to reward them for their efforts.
Definitely. And the question for me there was, Mikael, has COVID caused you to reduce any offers you had in trade? The answer to that is a resounding no, it hasn't. We are, like everybody else, we are obviously open for business. We're pushing transactions along. We have term sheets in place where we actually haven't been able to meet face-to-face with founders, and we will complete on those, subject to due diligence checking out. We haven't changed any of those. We are always mindful about paying what we believe is a reasonable valuation in terms of the growth prospects we're seeing for the business. But like everybody else, we're subject to market forces. So, we can't deviate too much from that, and we haven't retracted on any offers out there. So I think those were the main questions we had. So unless there is anything else that I'll give people 15 seconds or so to post any more questions in the Q&A. I do think we've had some tech issues with Zoom. There's been quite a few people on the webinar, which is great, obviously. But we'll leave it for, also, I think there's questions in the chat, actually. So let me see what we can hear.
First one coming up about what about financing terms for earlier companies?
Yes. What about earlier stage deal terms?
I think those have broadly been unaffected. You know, in many ways, a startup company is not reliant on ARR growth, obviously. And, you know, it's ARR growth in today's market that people are a little bit more concerned about. And so, you know, funding a company that is able to, you know, hunker down right now and build and develop its tech, you know, there's never been greater access to a pool of talent, many who are still furloughed or available, who are concerned about their positions, finding those teams and building them. It's a great time to do that right now. So we haven't seen earlier stage terms affected at all.
Interesting. There's another question here, which is, how can entrepreneurs get better leverage when negotiating in this market? And I think just like as an investor, it's really difficult getting any particular leverage from the situation because the market is reasonably effective. There's lots of investors and money out there. So maybe on the edges you can. I think it's the same old advice, right? Make sure you have a very clear, crisp proposition. Make sure you have nurtured the relationships to those investors you're targeting for quite some time so they understand you and know what to expect from you, and make sure to get yourself in a competitive situation. I don't know if there's much more to it. Would you add something to that, Ylan?
No, I don't think there's much more to that. That's right.
Very good. Another question here that came through. What do you think are reasonable founder ownership, shareholding and options percentages when getting to Series A?
So when first getting to Series A, you know, I think a company should still be predominantly founder-led and founder-owned through its Series Seed. Some dilution at that point, say 20%, 25, 30%, and an option pool available of 5, 7.5, 10%. But the rest should be founder-owned, founder-controlled at that point coming into Series A. And then suffering a further dilution suffering is the wrong word to use maybe, but experiencing a further dilution at Series A, potentially by about 30%.
Yeah.
I think the numbers will vary on the kind of the economics of each individual deals, but somewhere around there is where I'd say the center of the market probably is.
Yeah. There's a corollary to that question there. And again, what is enough skin in the game in Series A and Series B? And I will weigh in here that one of the challenges that we see with companies that are sort of between Series A and Series B and who have been around for a while, maybe had a little bit of changes in the core founding management team, etc., started to bring in external management, is that they're getting a little bit too diluted there. And I would typically say that you're probably not, at least not at Series B, you wouldn't necessarily see a majority for the founding team and management. But if it gets below sort of 20, 30%, that means it's starting to get difficult for investors like us to accept that. Would you comment on that, Ylan?
That's right. And so one of the features, and it's a relatively new feature, but it's not that we've not seen it before, but we're seeing it more frequently, is in some of the Series C financings that we're doing, which might be relatively flat or slightly up on before. By the way, flat is the new up round. In some of those deals, we're seeing option top-up pools, including founder top-up, so that founders aren't diluted by some of the extension rounds that are happening. There's a recognition that there is a round happening, and somehow we need the founder not to be diluted by this later round. So we are seeing a little bit of that, founder top-ups, and it's an interesting concept, of course, because it's the founders negotiating the term sheet and bringing forward ones that they like. But in an open discussion, that is certainly an option that is available at later stages.
Interesting. So it looks like the Q&A is actually up and running again. And I'm mindful that we shouldn't spend way too long here, but there are some additional questions here, and I just want to make sure we're trying to cover as many of them as possible. So one here is coming back, I think, to what we discussed earlier about any terms changing here. Have you seen investors wanting to take a more hands-on approach when it comes to consent veto matters, or increasing the list of veto matters, or likewise appointing more than one director to the board? I will say, hands out, I have not seen that.
No, I've not either. We're seeing a slight increased pressure on the number of observers coming to boards, and we're seeing a little bit, particularly in some of the slightly distressed companies, those that are finding the current environment a little bit more difficult, where investors are asking for greater access to information and more visibility on how some of the metrics are working. So getting involved in weekly updates. So, they are actively following the investment without necessarily being hands-on. So that's not going directly to control, but they are being very much more active. To the extent it's relevant, one of the other features that we're possibly seeing more of is tranched investments on milestones. So instead of putting all of the money up front, investors are drip feeding some money in, setting some guidelines, some KPIs, some milestones under which the next bit of money will automatically be released to the company. And that's why in the interim period, they might be asking for a little bit more visibility of data.
Very good. So the next question here, there seems to be a couple of people who are interested in the earlier stages of the market here, which is great. Sounds like deal terms and timelines remain basically unaffected. What about business formation and the very earliest seed rounds? I honestly wouldn't have a perspective on that.
So, we work very closely with and have great relationships with some of the incubators like Y Combinator, like Entrepreneur First, like Seedcamp, like Local Globe. They're all still very active. There are still people who are building and designing things in a better way and implementing in a neater and tidier way than people were doing that before. And they're excited by the opportunities of finding and meeting those people. I'm going to say often creativity comes from downturns, and many people will talk about some of their best investments having been made or come from downturn periods, and that's not just because they're getting slightly cheaper. That's because the renewed focus on creativity, this is slightly broken, how do we do it better, or how do we do it differently, happens a little bit more. So yes, the early stage seems to be less affected.
Interesting. Here's the next question. What is your view of the raise quantum at Series A? From Crunchbase, the US seems to view at $15 to $15 million raises, whereas the UK seems to be much lower. And I think, with UK, we can probably equate that to Europe primarily here. I mean, my perspective is that a real Series A today, at least in the space where we're at in business to business SaaS, where you actually have to build a really proper product, you have to build a go-to-market organization to sell it usually. An A round is probably somewhere in the range of 5 to maybe 10 million, not necessarily 15. There certainly are rounds which are larger than both 15 and up to 20, but the sort of median or average round we're seeing is probably $5 to $10 million in Europe. What do you see, Ylan?
That's right. We're seeing people play with names, and so we're doing a lot of, Series C2 or an A+, or extension rounds, because people aren't wanting to use up the next letter yet, for fear of growing too big or the size that they might be at the next round, and that placing them in position. What you call it is fairly irrelevant, of course, but there is a market perception around the branding of what your round was. And where you should be by various letters. So yes, a Series A is 5 to 15. Of course, we see bigger ones and have worked recently on some much larger rounds than that, which has been fun and exciting.
Yeah. Coming back to one of the earlier things we discussed here, you spoke a little bit about any, sort of tools and mechanisms for rebalancing valuation tied to performance milestones. So there's a question of how would you actually implement? Is that through options or other tools, or would you comment on that, please?
So there's a few different ways of doing that. One of the interesting ones that I've done at the moment is we have a valuation cap and a convertible note, and that valuation cap is by reference to increase in ARR from the current ARR level. And so that's improve your ARR, your valuation cap goes up. So, it's an interesting alternative method of financing. On some of the others, it's a slightly simpler mechanic. I don't want to bore you with the corporate law mechanism of doing that, but it's effectively saying that, you would have come in at a £2 per share valuation, but instead you're coming in on a £1 per share valuation because you've got a different valuation. And so if we achieve it and you should have been in on the 2, all we do is we take all of your shares and divide them by 2 and either forfeit or convert half of your shares into a deferred share, which means on the ones that you have remaining, your effective price was £2 a share. And so it's a reissuing of shares or a taking away of some of the issued shares to rebalance.
Really good. There's a question here that from an Oxx/investor perspective, what do you think companies should prioritize between Series A and Series B in this climate? And I think for us, it's what we've always requested, right? We're investing in companies that have shown a clear product market fit. So they have a product that is out there, it's operational, customers are using it, hopefully customers are advocating it and loving it. They will have some substantial metrics around usage, around how that product is being deployed. Hopefully that translates into significant growth rates. But where I think, we've always been very concerned as a B2B SaaS investor is around the unit economics and the actual underlying profitability of the business model, which honestly is not visible in the P&L or a cash flow statement from a business like this. I think that's come more into play in fashion. And there are more people who are talking about establishing a sound business model where you can prove that your unit economics or the leading indicators of such unit economics are actually tracking in the right direction. So you can make some realistic assumptions around where those are heading, rather than maximizing growth at all costs. I think even if there is a lot of money available out there in the market, people are starting to shift their mindset a little bit towards, okay, let's make sure we see that we have a reasonable and profitable business model before we push too much on the gas. I don't know if you've seen anything like that, Ylan, or...
I was actually going to follow that up with a further question, if I may, which is how important is cost control and cash preservation, extending your runway to the next financing round. All of those features, which when you look at portfolio companies or potential portfolio companies, how important are those features?
Yeah, I think controlling your own destiny, given uncertainties, right? We've obviously said that deals are getting done. There's lots of money out there in the market. But if you are a company that has, a lot of strengths, but some things you still need to work out, that is a tougher proposition in the market. And their number one priority for you should be controlling your own destiny. Under no circumstances can you run out of cash and have your back against the wall when you need to go out and fundraise. So I think that's something that people are internalizing quite dramatically. In some cases, that means cost cutting. In some cases, that means less aggressive market investments or less aggressive product investments. But I think the key thing is also that no companies, at least not which we are involved with, can save their way out of a crisis. They still need to invest aggressively in product. They still need to invest aggressively in customer acquisition and customer retention. So I think, keeping track of those core metrics, ensuring that you're balancing your cash position so that you don't end up with your back against the wall, that is the key thing to focus on.
Yeah, and there's a point coming out of what you said, which is, never raise money when you really need it. That pressure towards the final time and uncertainty around this month's payroll just makes for an untidy transaction, untidy terms. Being a little bit ahead of the game and planning for it is a great idea.
Yeah, absolutely. So there's a couple of more questions coming in here now. I sort of opened the box a little bit on unit economics and everything. So there's question coming in where the benchmarks are and where they should be at, etc. I will honestly actually defer that. I'm very happy to answer those one-on-one or in another webinar, but I think we're getting sort of towards the end of the theme we have here. So we're getting to the wrap-up stage. And thank you all for participating today. Hope you found the discussion interesting, judging by the interactivity in the Q&A. It seems like everybody enjoyed it. Thank you also, Ylan, for providing your insights and perspectives. I really enjoyed it.
Thank you very much.
Thanks, everyone.
Good to join you. Thank you, everyone, for joining.
Thanks.